Hey everyone, and welcome. So today, we're going to dive deep into a really fascinating topic, one that sits right at the intersection of law, finance, and some truly life-changing decisions: structured settlements.
Okay, just picture this for a second. You've just won a huge legal case. A truly life-altering amount of money is headed your way. The very first and probably the biggest question you're going to face is right here. How do you handle it?
So, before we jump into those choices, let's just make sure we're all on the same page. We're talking about how to take the outcome of one single moment, a legal settlement, and turn it into a reliable, secure financial future.
At its heart, a structured settlement is actually pretty simple. Instead of getting one giant, massive check, you get a series of guaranteed payments over a set period of time. Think of it like this. It's the difference between winning the lottery all at once and getting a guaranteed, super high-paying salary for, say, the next 20 or 30 years. So how does this whole thing work? Well, the entire process is designed for one thing: security. It all kicks off with a legal agreement, right? Then, the defendant's side goes out and buys something called an annuity, which is just a fancy financial product from an insurance company that legally guarantees your payments will show up. And the best part? These payment schedules can be totally customized to fit your life, giving you a predictable, stable income right when you need it.
And this right here brings us to the core dilemma, the big choice. Do you take all the cash now, or do you opt for that steady stream of payments? This is really the fundamental question we're going to break down.
It's a real trade-off, isn't it? On one side, you've got the lump sum. That means total control, immediate access. It's your money right here, right now. But on the other side, you have the structured settlement. And with that, you're trading that immediate control for something else entirely: predictable, long-term security.
Now, this is where it gets really interesting, because the choice isn't just about the money. It's about you. It's about your own financial habits, your discipline. A lump sum could be amazing for a super savvy investor, right? But let's be honest, for a lot of people, there's a huge risk of it just disappearing. A structured settlement is built specifically to stop that from happening, making it perfect for someone who needs that income to last a lifetime.
And when you look at the pros, they are seriously compelling. The big one, and this is huge, is that for personal injury cases, these payments are often completely tax-free. Wow! Plus, they are contractually guaranteed, they are legally required to show up on time, and you've got that built-in safety net protecting you from spending it all too fast.
But of course, it's not a perfect solution. The biggest drawback is a serious lack of flexibility. Once you sign on the dotted line, you're pretty much locked in. Your payments are fixed, which means inflation can nibble away at their value over time. But it's that first point, that poor liquidity, that's a really big deal, and it leads us right into our next section. Okay, so you've got this great long-term plan all set up. Everything's perfect, but then life happens. What do you do when life throws you a total curveball and you need a ton of cash, like yesterday?
And this is a super real scenario for a lot of people, right? An unexpected medical emergency, the chance to buy your dream house, a once-in-a-lifetime business opportunity. These things pop up. So what are your options?
Well, the system does have a kind of escape hatch. But, and this is a big but, it is going to cost you. You can actually sell your right to future payments to a third-party company, and in return, they'll give you a lump sum of cash today.
Now, this isn't a simple transaction. You have to work with what's called a factoring company, and this is the most important part. A judge has to approve the whole thing. That court approval is a really crucial safety net, It's there to make sure you're getting a fair deal and not being taken advantage of. But that flexibility, it comes at a very steep price. We're talking discounts that can be more than 30%. So why so high? Well, it's a mix of the time value of money. Cash in your hand today is worth more than a promise of cash tomorrow. Plus, the company is taking on risk. At the end of the day, it means you could be giving up a huge chunk of your settlement's future value. It's a really stark reminder of that trade-off between today's needs and tomorrow's security. All right, let's wrap this all up by hitting some of the most important, nitty-gritty questions that people always have about these agreements. Okay, first up, are these payments really tax-free? This is probably the #1 question we hear. And for good reason. That tax advantage is a massive selling point. And the answer is usually yes. But, and this is a really important but, that tax-free status typically only applies to settlements from things like a personal injury or a wrongful death case. If your settlement is for, say, an employment issue, you might be looking at a tax bill. The devil is absolutely in the details here. Okay, next question. It's a little grim, I know, but it's something you absolutely have to ask. If you've got a 30-year payment plan, what happens if you pass away in year 10?
And this shows you perfectly why you have to read the fine print. If your payments are guaranteed, your beneficiary, your family, whoever you name, gets the rest of the money. Simple. But if the contract says they are life contingent, well, the payments stop when you do. That's it. It's a massive distinction that could change everything for your loved ones.
And last but not least, can you change the terms? What if your needs change down the road? Can you just call them up and tweak the schedule?
The short, simple answer is almost always no. This quote really says it all. The structure is basically set in stone. Besides that super expensive option of selling your payments, the deal you signed at the very beginning is the deal you have for life. That rigidity is part of the design.
So, at the end of the day, it all comes back to this one fundamental question. A structured settlement offers an incredible form of financial protection, a safeguard against bad luck and bad decisions. But it demands a trade-off. You give up control and flexibility in exchange for that security. The right choice? That depends entirely on your circumstances, your own self-discipline, and what you truly value most.